as you know, when you start putting in bill pay and direct deposits, it takes a lot of time to change your bank. So rather than changing your bank, maybe just take some of that money that you're not earning any interest on and consider transferring it to an online money market account. You probably can find rates right now around 2%, and it's not very hard to do. Maybe 5 minutes to open an account and then transfer things over.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 116. Last week's episode, I talked about the 5 best long-term investments that you can make, and I thought it was right to follow up with the best short-term investments that you can make. So we're going to highlight what I think are the 7 best short-term investments that you could make. And before we get into that, just a reminder, if you haven't gone to retirewithryan.com and completed my 2022 listener survey, I would greatly appreciate your help in completing that survey. It will take you less than a few minutes to complete. It's a 10-question survey to give me some feedback on what you like from the podcast, things that you'd like to see me improve upon, and help me in just continuing to make this the best retirement podcast that it could be. So go and check out retirewithryan.com. And while you're there, if you don't have a plan for retirement or you need help updating your retirement plan, consider attending one of my in-person retirement workshops. So whether you have money in cash or you're a conservative investor and you're looking for good short-term investments, it's a great time to be looking at your short-term investments because, as you are probably aware, the Federal Reserve has been raising interest rates aggressively this year, and it's making it better to be a short-term investor. In years past, if you had money in the bank, money in CDs, you really weren't earning much interest at all. But now, unfortunately, though it's due to high inflation that we're seeing, we are, however, seeing the ability to earn at least a reasonable rate of return on your short-term investments. So the first short-term investment I want to highlight, number 1, is online money market account. Chances are that you're maybe already doing business with an online bank. It used to be that your bank was local, right? You felt safe going to your bank. They had a big brick and mortar building, maybe even stone, and you dealt with your local bank. Well, for many years now, many of us have been doing business online with our banks, and you can do the same thing to find a good money market rate. You can go to a website like bankrate.com, NerdWallet. I know on bankrate.com, they have a section under there where you can find online money market rates. So you want to find what the options are and also read the reviews, because not all online banks are created the same. Maybe some of them have stipulations where your money is tied up for a certain period of time, or there's limitations on transferring money in and out, or maybe they just have a very unfriendly mobile app. So you want to look at all that, and then provided you're comfortable with that, then you can pick one of these online banks. So that is an option if you're sitting on a lot of cash in your checking or savings account. Chances are your local bank is not paying you anything, right? I do business with Bank of America, and I've been doing business with them for many years. I frankly would like to get rid of doing business with them, but as you know, when you start putting in bill pay and direct deposits, it takes a lot of time to change your bank. So rather than changing your bank, maybe just take some of that money that you're not earning any interest on and consider transferring it to an online money market account. You probably can find rates right now around 2%, and it's not very hard to do. Maybe 5 minutes to open an account and then transfer things over. Number 2 is also a money market account, but this would be a mutual fund money market account. So money markets have 2 varieties. One is through a bank or a credit union. Another would be through a mutual fund company. Like, as many of you know, many of my clients hold their money through TD Ameritrade Institutional. So through TD Ameritrade, we have access to a number of money markets. And since the merger also with Charles Schwab, there's some additional ones that we can choose from. So one of them, the Schwab Value Advantage Money Market, the symbol is SWVXX, is yielding about 2.26%. But it does have an internal expense ratio of 0.34. So that reduces that 2.26% by that 0.34. So it is maybe paying a little bit less. It's paying about 1.92 net of fees than an online money market. But if The reason I mention this is that if you already have a brokerage account with Charles Schwab, with TD Ameritrade, with Fidelity, and you have a lot of cash sitting in there, if you investigate, maybe you can buy one of these money markets like the one I mentioned, or maybe even another one. I know Vanguard has a similar money market, VMFXX, that's yielding around 2%. It has about a 0.19 expense ratio. So that's an option. If you want to keep all your investments in one place, say you want to have your stocks, your bonds, your mutual funds, and you want to have money market in one account, consider using a brokerage or mutual fund money market. And I'm listing these investments in the order of their liquidity, being the most liquid first. So money market is very liquid. Most money markets, whether it be an online bank or mutual fund money market, don't have any restrictions. Some of them might have an investment minimum to get the higher yield. Maybe you have to put in $3,000, like in the case with that Vanguard money market. With the Schwab money market I mentioned, there is no minimum. So the best short-term investment, number 3, would be something like a 1-year CD, right? 1-year CDs are always a good option. And you also could go to bankrate.com. I went there earlier, and I'm recording this podcast on September 21st. So keep in mind, all these rates I'm mentioning are subject to change. They probably will go up since the Federal Reserve just raised interest rates earlier today. But a 1-year CD is paying a little bit more than a money market, about 2.75%. And that would be going directly with a bank, an online bank. You also could try your local bank. Sometimes local banks, local credit unions will offer promotional rates. Maybe they're higher than that. And the thing you have to keep aware of anytime you're dealing with banks is the FDIC insurance, making sure that you're not over that limit. And so with a 1-year CD, if you did have to get your money out of it early, you might have to give up some interest. So that is a negative. The other thing is that because interest rates are probably going to keep rising, if you're going to need this money relatively soon, you probably would want to think about a money market. But if you could invest for a year, you could get about 2.75%. And then I've also found that through some of the brokerages that I deal with, such as TD Ameritrade, they have brokered CDs, which essentially are CDs, but they're sold through a brokerage firm, but backed by a bank. And some of those I saw 3.5% for 6 months. So the rates are getting a lot better than they were. Next would be number 4 would be considering a short-term bond fund. So what does that mean? It's a bond fund that invests in short-term bonds. This could be mostly government bonds. It could be some bonds issued by corporations. It also could be municipal bonds, but short-term means the length of the bonds. And I would suggest sticking right now with an ultra-short fund, which is usually a few years or less of length of the bonds that they're investing in. So one fund that I've been using for years is the JP Morgan Ultra Short ETF. The symbol is JPST. As of the end of August, the fund is yielding 2.88%. That's what its 30-day yield is. It has an internal cost of about 0.18%. So that reduces your yield. And year to date, it's basically flat on the year. Because as I mentioned before, the Federal Reserve has raised interest rates, and the enemy of all bond funds, and all bonds really in general, is rising rates. So it's been very hard for bond funds to make money this year. Another one is the PGIM, that's Prudential's investment arm, and that symbol is PULS. That one's yielding 3.18. That one has a 30-day SEC yield of 3.18% and a very similar internal expense ratio of about 0.15. And year to date, that fund is up 0.34. Now, that might not sound great, right? If you're in a bond fund, you're hoping to make money. And if you're in one of these funds for the year, you're basically flat. But when you compare that to something like a total market bond fund, for example, Vanguard's total market bond fund, which is one of the most heavily invested bond funds out there, it's a good fund. It's called, the symbol's BND. That fund is down over 13% on the year. So if you've been in that fund, you've seen a lot of losses because, as I mentioned, the interest rates have been rising. That's really hurt the price of bond funds. Now, that fund is yielding a little bit more. It's yielding 3.67. But if you've stayed in that fund all year, you've really been hurt. So one thing that we were advising clients was to shorten up their duration for a number of years. We had no idea the Federal Reserve was going to raise rates as aggressively as they are, but we felt there would be some increases. So if you're in a fund like that, you could obviously stick it out, or you consider maybe shortening your duration to try to protect from further declines, because it does look like we will still see some more increases this year. Now, if interest rates were to be cut and they were to be lowered, The opposite will happen with this fund. You'll see the price go back up, but it doesn't look like we're anywhere near that. So there could be other short-term bond funds that you can consider, but these are some of the ones that I like. Best short-term investment number 5 would be consider investing in Treasury bonds. What's going on right now in the Treasury market is that you're seeing that the shorter-term bonds are actually paying more than the longer-term bonds. Normally what happens is the longer term the bonds go out. So for example, if you were looking at a 2-year Treasury bond versus a 10-year, you should see the 10-year U.S. Treasury bond paying more than the 2-year. But what's happening now is the 2-year Treasury is paying more than the 10-year. So you could buy a 2-year U.S. government bond that's paying almost 4% interest, about 3.95%, versus a 10-year U.S. Treasury is paying 3.5%. So you definitely want to stick more with a short-term Treasury. And if you buy one of these, you do have liquidity. You could sell it if you needed the money. The negative is that anytime you sell a bond, if interest rates have gone up, the price could go down. But if you're willing to hold this bond for 2 years, you know that worst case, you're going to get almost 4% interest. The other benefit of buying U.S. Treasury bonds is that if you're doing this outside of a retirement account, where normally you pay interest on the Treasury bonds, this isn't subject to state income tax. So in the state where I live, Connecticut, there's state income tax. In many other states there are. So you don't pay state income tax. So that actually increases this yield a little bit more. You do still pay federal income tax, but this would be a great alternative maybe to some of the other ones I mentioned, with the caveat, just like with the bond fund, if you buy a bond fund or a Treasury and you want to get out of it early, there could be some losses. Best short-term investment number 6 would be if you're willing to have even less liquidity and you want a little bit more yield, you could consider something like a fixed annuity. I've talked about annuities in some past episodes, and what a fixed annuity is it's an investment that you're making with an insurance company, and they're taking your money and going out and investing it, and they're willing to pay you a higher rate of interest because you're giving up some liquidity. I'm looking at a 3-year fixed annuity. What that means is that if you want your money out in 3 years, there could most likely be penalties that you'd have to pay, and you may even not be able to get your money for the first year or so. It depends on the annuity. But I found some rates out there that were paying about 4.4%. So you're getting a little bit more than the 2-year U.S. Treasury, but the money is tied up more, and it's also completely subject to state and federal income tax when you take the money out. However, you could leave the money deferred for your entire lifetime if you wanted. And then your heirs would pay tax on the gains you've had in the annuity or annuities. So that's the trade-off. If you're willing to give a little more liquidity, you can get a little bit more yield, or you could just use something like the Treasury and just wait the 2 years and then maybe even reinvest at a higher rate. And the last short-term investment I'll mention, I've talked about in another episode, but I always like to remind people about this because it probably still is the best short-term investment that you could make. And that would be buying I-bonds. These are government bonds, government Treasury bonds that are I-bonds, meaning they're tied to inflation. And the way these bonds work is that every 6 months, the Treasury looks at the consumer price index and they measure the change in that. And that is the interest they pay for the next 6 months. So what's happened is you could imagine we have very high inflation. The last reading that was taken in May showed that we had annualized 9.62% inflation. So the bond is paying for the next 6 months an annualized rate of 9.62. Now, you don't get 9.62 for 6 months. Hopefully, we never get to that point of inflation. You're getting half of that, 4.81%. You're getting that for the next 6 months. So if you buy one of these bonds anytime before November 1st, that's going to be your interest rate for the next 6 months. And then they'll look at where inflation was from November 1st back to May 1st. And if there's been inflation, like I'm sure there will be, they'll then determine another rate. So this happens every 6 months. Now, these are not some hidden investment that you didn't know about. It's just that there hasn't been inflation for a very long time. So if you'd owned these bonds prior to really November of 2021, you'd have been earning about a 1 to 1.5% interest rate. But because there's been so much inflation, now the inflation component of these bonds is kicking in, so you're getting a lot more interest. And it's most likely we'll see an interest rate close to this for the following 6 months. So some of the negatives of these are, one, that you can only invest $10,000 per Social Security number. So if you're married, you and your spouse could each put in $10,000 per Social Security number per year. If you have minor children, you could put money in their name too. So maybe if you had 2 children, you could put $40,000 in this year. You can't sell them for 1 year. And then for the following 4 years after that first year, if you sell them in those following 4 years, you give up 3 months of interest. After the 5 years, there's no penalty. So these really are a 5-year investment, you could say. Now, you could hold them for a year. If you wanted your money back, you'd give up 3 months of interest. And even if you did that, you'd probably most likely earn a higher rate of interest than you could on anything else. So these are probably the best, but there's the $10,000 per Social Security number per year limitation. The only other way around that is that if you do have a tax refund, you can invest up to $5,000 of your tax refund per year also. So that could get you up to $15,000. So talk to your accountant. Maybe it makes sense to create a very big withholding on something so that you owe more than $5,000 or $5,000. Then you could put the $5,000 in plus $10,000 to get even more in there. So I hope this is helpful on finding the best short-term investments right now, the best ones for you. Again, take a look at your cash, your bank accounts, right? There's definitely some changes that you should be making because it's worthwhile. If you can earn 2%, maybe even 4% on this money, it really starts to make a difference. Whereas in the past, maybe you were getting 0.5% more interest. It wasn't really worth it. So as a reminder, please go to retirewithryan.com to complete my 2022 listener survey. And if you have a question you'd like to have considered for a future episode, I'd love to hear it. Have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.